Welcome to the Deep Dive. We're here to cut through the noise and give you the real story behind the latest business news. Today, we're digging into Tata Consumer Products, TCPL, specifically their Q1 FY26 results and, well, what it all means for their future path. We'll pull out the key insights so you get the full picture fast.
That's the plan. We won't just read out numbers. We'll look at the Q1 financials, sure, but also connect them to TCPL's strategy. It's about seeing where they are now and figuring out where they might be heading.
Okay, let's start with the big picture for Q1 FY26. So, looks like stable growth in revenue and profit, which, sounds okay. But digging a bit deeper, there's definitely some pressure, especially on the margins. We saw good volume growth in salt. That's a consistent performer for them. But beverages, hit by seasonal issues.
Right.
On the upside, tea prices were looking good, and actually they're expected to drop even more, so that's positive. But then the non-branded side had a softer quarter, mainly because coffee prices dipped.
Yeah, and what's quite fascinating, I think, is that even with these specific challenges, the view seems to be that TCPL's long-term growth story, it's still pretty much intact. The market seems to be looking beyond these, immediate bumps, although it's worth pointing out the current valuation. It's flagged as overvalued. The stock's at rupees 1,062, market cap around rupees 1,005,152 crore.
Overvalued. That definitely suggests high expectations, doesn't it?
It really does. The market's pricing in a lot of future success.
Okay, let's unpack the numbers then. Consolidated performance for Q1 FY26, ending June 2025. Sales hit rupees 4,779 crore, so that's up 4% from the last quarter, March 25, and a pretty healthy 10% jump year over year from June 24. So, the top line is growing.
Absolutely. That 10% year-on-year growth is definitely solid. But here's where it gets a bit nuanced. While sales climbed, the gross profit was rupees 1,916 crore. That's actually down slightly 1% from Q4 and 2% from last year.
Okay, so costs are biting.
Seems like it. It squeezed their gross margin down to 40.1%. Last year was 44.9%.
Wow, that's almost a 5 percentage point drop.
Exactly. So that compression, even with more revenue coming in, it tells you costs, like raw materials, went up faster than sales did.
And I guess that squeeze just continues down the line. EBITDA.
Yeah, EBITDA, that's earnings before interest, tax, depreciation, and amortization, came in at rupees 607 crore. That's down 2% from the previous quarter, and a bigger drop, 9%, compared to last year.
So the EBITDA margin must have taken a hit, too.
It did, down to 12.7%. That's a drop of 77 basis points quarter on quarter, so nearly 0.75%. And year over year, it's down 263 basis points. That's 2.63 percentage points.
Oof. A drop like that in EBITDA margin, what does that really signal about, day-to-day operations?
It's pretty sharp, yeah. It suggests their core operations are facing higher costs, or maybe they couldn't raise prices enough to cover them, or perhaps both. It directly impacts the cash generated just from running the business before you factor in financing or taxes. It's definitely something to watch. But here's where it gets interesting. The net profit actually increased.
Even with those margin pressures.
Yeah. It rose 12% for the previous quarter, hit rupees 334 crore, and 9% year over year, up from rupees 307 crore.
Okay, hold on. How does net profit go up when gross profit and EBITDA margins are going down? That feels counterintuitive.
It does, doesn't it?
Is this sustainable or maybe like a one-off thing?
Well, it points to something else going on. It looks like a significant factor was actually a one-off gain.
Oh, okay.
Probably from selling an old asset. It gave the bottom line a nice boost.
So it kind of masked the underlying operational pressure we saw in the other margins.
Exactly. It's a smart financial move.
Yeah.
Helps the quarterly picture look stronger. But yeah, it underlines why you need to look past just the net profit sometimes. And speaking of costs, raw materials were huge. Rupees 2,863 crore. That's up 53% QQ and a massive 70% jump YoY.
70%, wow.
And employee costs climbed too. Rupees 386 crore, up 12% both QOQ and YoY. These are big increases impacting those margins we talked about.
Okay, let's break it down by segment then. Where did these numbers come from? How did the different parts of the business do?
The branded business in India, that seemed to do okay. Revenue was rupees 3,125.7 crore.
Right.
That's up 6% from the last quarter and a good 11% jump from last year. Though the segment results for India, rupees 290.29 crore, while that was up 20% QOQ, it was actually down 11% year over year. Interesting mix.
And then the branded business internationally, revenue there was rupees 1,145.2 crore. That was a bit down, 4% from the prior quarter, but still up a solid 9% compared to last year.
Okay.
Segment results internationally were rupees 154.55 crore, down 2% QOQ and 12% YoY. But what's quite interesting for the international side is their margins actually started to recover in Q1. They'd been hit by volatile coffee prices in the US before that.
So putting both branded segments together.
Overall, branded revenue grew 3% quarter on quarter and 11% year on year. So yeah, consistent growth there.
Okay, what about the non-branded part? Right, the non-branded business. Revenue actually went up to rupees 535.76 crore. That's 7% growth, both QOQ and YoY. But the segment results took a big hit, down 42% from the last quarter and 33% from last year, ended up at just rupees 64.52 crore.
Ouch. And that was mainly the coffee prices you mentioned earlier.
Exactly. That segment really felt the impact of weaker global coffee prices on their sort of bulk coffee operations.
Right. Got it. Okay, let's shift to key highlights and maybe some strategic analysis. The core food business you mentioned showed a strong rebound. Salt especially saw volume-driven growth.
Yeah.
And both core tea and salt had double-digit value growth. For beverages, though, the growth was mostly price hikes for tea, less about volume.
Correct. The beverage portfolio overall was a bit subdued. We touched on it, those seasonal challenges. Unseasonal rain hit demand for summer drinks, the ready-to-drink stuff.
Right, bad timing.
But the silver lining, as you said, tea prices were good for TCPL. And they expect them to fall further this season. That's really positive for future margins since tea is such a big cost input for them.
Okay. Now, what about these newer growth businesses? The acquisitions like Capital Foods and Organic India, how are they fitting in? Their contribution to domestic sales actually dipped slightly, down 100 basis points year over year to 28%.
Yeah, that's right.
Attributed to supply chain issues and sort of external challenges. What kind of challenges are we talking about, and how do they fix that?
Well, often when you integrate new companies, you get temporary hiccups, maybe inefficiencies in linking up systems, or just challenges getting traction in new market segments quickly. But despite that dip, the plan is definitely for growth there to accelerate. They're focusing on innovation, getting products out more widely.
So they expect them to bounce back?
Oh, yeah. The projections are ambitious. They're looking for these businesses to grow around 30%, much faster than the core, and eventually contribute about 30% to TCPL's overall growth. It's a really key part of their future strategy.
Okay. So back to margins for a sec. Overall, EBITDA margins got hit by those high tea costs in Q1 and the lower margins in plantations from weak coffee prices. Sounds like a bit of a balancing act.
It really was. But connecting this to the bigger picture, the good news is they expect margin improvement starting Q2 FY26. That pressure from tea costs should start to ease off.
Ah, okay.
In fact, the company's put out guidance for the full year, FY26. They're aiming for an EBITDA margin around 16%.
16%? That's a pretty strong target, given where they were in Q1. Shows confidence.
Definitely shows confidence they can manage these input costs going forward.
So let's talk about the future then. What does all this mean? Despite the Q1 headwinds, the long-term story is still positive.
That seems to be the consensus, yes. They're looking past the current, bumps in the road and focusing on the strategic path.
And what drives that optimism?
Well, the expectation is improving input costs, mainly P, combined with the momentum they expect from those growth businesses we just discussed. That combination should drive better overall growth and, crucially, stronger margins. It's about leveraging the core strengths while expanding into these new high-potential areas.
And in the domestic market specifically, what are the levers?
Key drivers are expected to be a revival in urban demand, always important for consumer goods, plus getting synergies from those recent acquisitions as they integrate better. And they're still seeing good momentum in their value-added salt portfolio, innovating around a core product.
Right.
They're also planning to focus more on premium products and expanding that ready-to-drink range.
And internationally.
Well, in the UK, expanding distribution has already given tea sales a nice boost. That shows their global reach strategy is working. And across the board, both domestically and internationally, e-commerce is the big focus. For their established organic brands and the new acquisitions, too, digital is clearly key.
What about Tata Starbucks? Always generates interest.
Yeah, Starbucks looks set for stronger performance. Demand seems robust, and they're still expanding aggressively. Added 6 new stores in Q1 alone. That brings the total to 485.
Wow.
And the plan is to keep growing, not just in big metros, but in smaller cities, too.
Okay. And overall guidance? Still sticking to those growth targets?
Yep, they've reaffirmed it. Growth business is expanding around 30%, contributing 30% to overall growth eventually. It's all part of this ongoing business transformation. Acquisitions, innovation, supported by more marketing spend.
Yeah.
It's a comprehensive strategy for long-term growth.
All right, let's wrap up with the projected figures. What are the forecasts looking like for TCPL? Revenues projected at rupees 19,556 crore for FY26E, and then rupees 21,903 crore for FY27E. That's quite a step up from FY25's rupees 17,618 crore, shows confidence in scaling.
It does. And for EBITDA, the projections are rupees 2,836 crore for FY26E and rupees 3,285 crore for FY27E. And importantly, the EBITDA margin is projected to recover 14.5% for FY26E and 15.0% for FY27.
Okay, so that 16% full-year guidance feeds into these improving projections.
Exactly. It shows that expected margin recovery baked right into the forecasts, a clear signal of anticipated improvement.
And bottom line, adjusted net profit, Pipe.
Projected rupees 1,565 crore for FY26E and rupees 1,862 crore for FY27E. Steady growth expected there too.
Okay, and earnings per share, EPS.
EPS projected at rupees 16.8 for FY26E and rupees 20.0 for FY27E. Now, tying back to valuation, the stock's price-to-earnings ratio, the PE, is projected at 63 times FY26 earnings and 53 times FY27 earnings.
53 times FY27.
Yeah, and the current PE is already around 53 times those FY27 projected earnings.
So like you said earlier, the market's already pricing in a lot of that future growth.
Seems that way, yes. High expectations are definitely built in.
Okay, so to sum it all up, Tata Consumer Products had a Q1 FY26 that was, well, a mixed bag. Solid top-line growth, but definite pressure on operating margins. At the same time, they're clearly making strategic moves, acquisitions, focusing on growth areas to position themselves for significant future expansion. It's a company balancing present challenges with ambitious future goals.
Absolutely. And maybe a final thought for you, the listener, to mull over. What opportunities does this specific mix, the margin pressures, the strong core business, this aggressive growth strategy, what opportunities might that create for a company like TCPL in this constantly changing consumer world?
Good question to ponder. And before we go, just the usual reminder, please remember, we are not SEBI-registered financial advisors. If you are considering making any investment decisions, please consult a certified financial advisor.